Hey guys, this is the first video I'm recording on for this channel, which is gonna be about value investing, personal finance, specific stocks breakdown, quarters, earnings report breakdown, and such. But I want to talk about a concept as that I've never really attributed a lot of value to because as a long-term investor and such, but now that I know about it, I kind of use it the same way that a trader would use uh, not fundamental, but it's not fundamental analysis. They use the chart analysis. I can't remember what it is, but it's essentially with trading volumes and such, and the way that it goes, and they try to time the market. I try to do that, but in a lesser manner. I would say it's about capital capital rotation, okay, within the markets. And so the way that a stock moves, we'll do that in a 1 minute breakdown for those who don't know, are interested to learn about it. It's essentially about volume. So it's a supply, the market is an efficient supply and demand machine, which it essentially does. Like, there's going to be an AI, there was a lot of demand, and so the stocks are booming, and then they have like this, and that's like the all AI. Think of the AI stocks like infrastructure, let's say. So any like big AI stocks, including the infrastructure chip, all of that. So you have Nvidia, Micron, AMD, Vertiv, Intel, AVGO, Broadcom, same stock, but um, think of all of these stocks as like a mutual fund, let's say, and they all kind of rely on one another. So let's say Nvidia has a great quarter, it's going to be a great day for Micron too, more than likely, unless there's something specific company related with Micron. So let's say um, there's like a think of it as like the same as macro and micro. So let's say Nvidia has a phenomenal quarter. Most of the stocks in your like regroupment of AI stocks are gonna do good, and then it says, oh, Micron, we have a problem with Micron. They won't be, their chip doesn't work with our new whatever whatever, and so then Micron specifically is gonna drop a lot, but the rest of the stock is gonna go up, and that's kind of like how it goes. So it's like with the influx of information that come in, the market like charts itself, and it works with volume, trading volumes, especially institutional, that makes the market move the most. Now, there's this thing about capital rotation. When you're a value investor, what you're trying to find, as in the best way, and there's other times where the stock is going up, but you look at it and you're like, it's so cheap still at this point. And so if you're gonna hold it for a long time, you think it's like a stock that in 10 years is gonna be good, you don't have to do that. But what I personally like to do as a way to edge my risk, like as a way to like make mitigate my risk to a certain extent, is to buy a stock while it's low. Like, let's say I have a kind of like a almost a fetish for it. I buy like Adobe at that. I'll buy Netflix right now. I love looking at Netflix because it's at the lowest that it's been in a long time. They have a new revenue stream with like the ad platform and such, which is a good revenue driver, and it's expected to grow quite a bit. They've expanded into games already, but not to the extent where I feel like if they have a big breakthrough there, that could be something big in the next couple of years. Sports, all of these things. But right now, it's traded. The all-time high that Netflix reached was $133 a share, and right now it's at 82, and they haven't diluted since then or anything. So it's like and at that time it was what, like around 35 of P, I think, something like that. Now it's at what, 27? And it's gonna keep, it's a company that has historically, like, it kept growing. Now they've like changed product, added sports, um, and are expanding into sports. They got a deal with Paramount where, because it's a capital heavy business, but I don't want to turn this into a Netflix breakdown, but essentially you had the Warner Bros. Deal, and then it didn't work, which made the stock go back up. And then they had the Paramount because they canceled, because they had to like cancel the deal. They had this agreement, and Paramount had to pay $2 billion to Netflix, which is like, imagine, just think of it from a purely production of like movies and like putting on events together and such. You have a free $2 billion to produce crazy stuff, and Netflix now like a cash flow machine. So it's a phenomenal stock, I find. And right now, the like institutional, it was all pulling out when the Warner Bros. Deal, but then it came back to it, and now it's back down because they said that they'd have like the biggest amount of um, I don't want to get into the specifics, but that's my point. It's like, when invest, like, don't think of it like, oh, are institutions out? Think of it in a way that's like, why is this stock so low? And the reason is because most of the institutional capital that was into it just left for like to rotate into another sector. So let's say they use okay, Netflix after the Warner Bros. Went high. Now their earnings didn't go great. Boom, they pull out of this, and then they'll rotate into AI or something, and then they'll pull it into Broadcom, and oh, Broadcom had bad earnings. Boom, they pull it out, and they put it into something else. They'll move it to software. Let's say, oh, ServiceNow has had the conference with Jensen Huang. They said they'd become a $1 trillion company. They're guiding for 30 million in revenue by 2030. They're super bullish. They're working with AI services. Boom, they put into ServiceNow or something. Like, they move into software. Like, they don't move into like AVGO specifically. I'm just saying the capital moves to like the AI, and then it's gonna move back to software. Then it can move back to like a media company like Netflix, and it can move back to this, to that. It's always gonna be a capital rotation cycle with institutions that aren't like long-term investors like us. And you must be conscious of this, because if you buy stocks that go high, like, I know this person that sees a stock go up, and they kind of invest into it. Well, it's most people do that. The general people go like, yo, it's been up like 50% in the past month. If I go in right now, maybe I catch another 50 and then I can quit. First off, most of these people, they don't leave because they got a greed problem where they're going to stay. They don't have an exit strategy. There's a terrible earning, goes down 30%, and now they sell because they're like, oh God, I don't want to take too much risk. I'm still up 20%. I'm happy about it. Which, that's fine, but maybe it's going to go down like, maybe you only went up 20 and then you went down 30. Then you lost 10% and such and such, because you invest emotionally. Now, what you have to understand is that when you move into a stock that has been going up like that, is that most of the capital rotation has happened. The capital that was allocated, like the move of capital that moved from this to this, has been added. Now, if they have a phenomenal, like most AI, like when the Mag 7 earning like dropped, like most people move the capital, not most people, but what happened was like move from specific Mag 7 stocks, or pretty much like industries on themselves, kind of, because they're $1 trillion companies. It's insane. But you have like Microsoft, where it kind of dropped, or like a little bit, and then you have Google that went like up crazy because it had phenomenal earnings. But you have to look at these things as like capital rotation. And so, okay, MSFT, it didn't go that time, but the earnings were great. It's just Google's earnings were greater. Now, if next earning Google deflates, there might be a capital rotation into MSFT. So while MSFT is down, don't think about it as a dead stock, like you're on Wall Street bet on Reddit. Think about it as the capital rotation hasn't happened yet, and it's going to. It's bound to happen. They have great earnings every time. Azure platform grew up 40%. Okay, Google grew up 72, but it's like there's so the capital went to Google. So the capital went to Google. So if you invest in Google right now, it's up like 10% already. The capital that was to be allocated into that reacted right away and it was invested. Now it can keep going up. It can keep going up as the media talk and more. And like now it's the retail people that go like, whoa. But while MSFT is down to 4%, the capital allocation, it's like a part of MSFT might have gone to Google or whatever else it went to. But it went down because the earnings weren't as great as people wanted, or whatever news, whatever influx of information that came in that made that happen. If you're down on a position like 10%, but you believe in the fundamental analysis, don't move emotionally because you see like Micron go up 8% in a day and you're down 10% in 3 months on a stock. Don't go like, oh, if I had put it there, it would have went up 50%. The reality is that if you had put it there, yeah, it would have went up 50%. But if your old investment strategy was that for a long time, like the track record for people who do that, it's like 90%, more than 90%, if you think of yourself as someone special, is people go down. People are down. They're negative on the market. No one beats the market on a long period of time by timing it in a way where it's like, oh, I'm going to invest. Oh, Micron's been up like 75% in the past 3 months. It's a great stock. You don't look at anything. You just see it. You like the movement that it does upward. So you invest in it. It's like, that's not how investing works. Investing works as a, think of it as a business. You have to understand the business very well. If you have 100,000 to allocate, and you don't want to do like S&P 500, which is the most thing, if you don't really know anything, put it in an investment. Like, put it in like a S&P 500, NASDAQ if you're big on tech, something like that, where it's like a regroupment of stock which are in different things. And yeah, it's tech stock like NASDAQ, but it also has AI and stuff, so it moves like this, and then over time it keeps going up. But I think if you must understand that capital rotates in a way where when your stock is going down, it's time to buy more. Because if you have a position where you have 1,000 and it's down like 10%, so you're at like 900 now dollar, and you're like, oh, okay, I'm down on this position, I'm gonna wait to be up. When you're up on this position, like let's say the next earnings they go up 8%, and now you're just down 2%, and you're like, okay, I'm gonna wait to be up, and then I'm gonna like cash out because I'm scared because it went down or something. It's like, dude, you're missing all the upside. What you should have done is that if you put another 1,000 while it's down 10%, and obviously I'm not saying that's always the case. You have your thesis and the fundamental of the business have to still be strong. Like, you cannot just blindly do that. You have to have a thesis on it. And as long as your thesis isn't broken, the stock movement doesn't matter. It's like Bezos said, we saw the stock like go from 113 to $6, but we looked at the internal metrics and it went up. Look at the internal metrics. No one cares about the stock movement unless you're like a trader or something like that. That's different. Then I can't speak to that. But you must understand capital rotation, when to get in. And what I was saying earlier with that stock, like that went up 8%. If you had bought another 1,000 while it's down 10%, now you have like 1,900 in it, and it goes up 8%, you'll have made your money back because your average price will be like between the down it will be like at the starting value, which is 10% above what it was, and then 10. So your basis, your like cost, average cost basis is going to be in the middle. So it's going to be at like 5% down. But then if it goes up 8, so you'll be up 3% about. And that's how you invest. That's how I invest. I see a position, I look at it like in a nutshell. Okay, what I do is I look at a company, I understand how they make money, I look at like the different earning like form that they have. um, then I see like, is that revenue, does that revenue keep growing? Revenue growth is very important in stock, to look at P ratios and such, because you have to understand like the metrics and such. So revenue growth is very important, like their margins, uh, their free cash flow. Once you understand the metrics plus the fundamental of the business, now when you see it at this certain price, do you think with the revenue growth that they have that the multiples are justifiable? And also, are you content with the amount of debt that it has, or debt it, like, are you fine with the amount of risk that it comes to buy into this? And I do. If I do, sorry about that. If I do this specific position, I put $1,000 in it. I like it at that price. So if it goes below that price and I have new capital to allocate, I will allocate it in that, unless there's like a better stock that I also invest in. So you go back. You don't go, oh, I'm scared now that it's down. Don't do that. That's like in emotional investing, and you don't win emotionally against the market. You don't win because you want to win. You win because you're a good capital allocator. When a stock goes down and you have a strong thesis on it, you understand it well. It's just that the the capital rotation hasn't hit it yet. So you have to be patient with that. So for example, I have Adobe right now. Adobe is not doing great today. It's lower than my average price. I don't have capital to allocate to it. Now, am I going to sell position I'm down on to buy it? No, because I don't want to sell position I'm down on that I believe in. I'll wait for my next entry of money that goes into my account. If the stock is still down and it's better than all my other positions that I'm going to look at as I recalibrate my portfolio, I'm going to put it I'm going to put it in Adobe. And once the like new software, because it's software AI a lot right now, that like the capital rotates in between one another, kind of like this, it's gonna go up. I'll be up, and at a certain point in a couple years, or maybe in a couple months, or whenever it happens and they have a great earning, like, see let's say the average P ratio of a company with a similar level of maturity as Adobe as is around the 20 something P, and then the AI threat dissolves, because software are going to integrate AI and they're going to be one of the biggest winners instead of losers as people think about it. It's like maybe it's going to go back up, and that's my thesis on it. I think that the price to earning ratio is super low as of this moment, based on the fundamental, based on their ability to adopt AI into this business. And I think that there's going to be a recalibration of the multiple. Kind of like happened with IBM recently. IBM was at 219, 216. I kept buying back in. And now it's up, like it touched like 331. Now it's back down to 280, because that was like the big rally. Now it's down to 280. I'm very much up on it. It went up to 331, but now it's down, like since that point is very much down. I'm okay with that. If it goes back down to a price where I'm like close to my average buying price, or I'll have to readjust myself and see if I still think that it's cheap at that price, which now I'm like, I think it's pretty much well priced in, but there's the quantum upside, so I'd stay in it. I'll see the next earning, how that goes. Essentially, keep building, see if the thesis is still strong. That's the way you invest. Don't base the value of of the company you're investing in based on the stock movement. Base it on the internal metrics, and don't be short-sighted. That would be my thing. I think I rented a little bit too much. Sorry about that. But this is the first video on capital rotation and whatever else there was in there. I'll keep making videos about value investment, stock thesis, earnings breakdowns. So thank you for tuning in if you did. And till next time.